Welcome and thank you for joining our latest webinar. I'm Milosz, Papst, Director of Investment Trust Content at Edison, and today we are looking at UK small caps. I'm delighted to welcome Richard Staveley, who is Lead Fund Manager for Rockwood Strategic. Richard will discuss the post-year-end outlook and the fund's positioning. Before we start, I just wanted to highlight that there will be a Q&A session at the end of the webinar, so I strongly encourage our audience to submit questions. Richard, the floor is yours.
Thank you very much, and welcome to everybody who's taking an interest in Rockwood Strategic. I'm afraid I have to assume that some of you won't have heard of Rockwood before, know very little about it, but there are also maybe some old hands or long-term investors getting an update. So you'll just have to excuse for both parties. I'll try and do the best for both of you, but some of it will be going over old ground. I'm sure you're well aware of all the disclaimers, but the key point I think to reiterate is I'm not giving you investment advice, and you should get your own proper advice when making investments. So Rockwood is a investment trust listed on the main market. I've been running the fund since late 2019. It's a specialist differentiated UK small companies fund, which we think we've proven this strategy over the last few years in this very inefficient part of the UK stock market, which is essentially stocks below £250 million at the point of purchase. We don't concern ourselves with the various benchmarks in UK small cap. What we're looking to do is generate absolute returns over the medium term. And what our objective is for every investment we make, we have an investment thesis that there is at least 100% upside in that investment, which we expect to be able to realize over a sort of 3 to 5 year period. Now, sometimes we'll end up owning them longer. Sometimes investments turn out to be a bit shorter, but on average, we're taking a kind of 3 to 5 year holding period. And if they double over the 5 year period, we'll deliver 15% IRRs. And that would definitely put us in the kind of all-time greats for small cap investing if we do that over the next 20 years. We're a value investor. It's a space which is most populated by growth investors, but we take valuation very seriously in this portfolio. And we run a concentrated approach as well. There are currently 25 holdings in the portfolio. And the majority of the capital is in the top 10 holdings. It's currently just around 63%. And we're also active investors, not activist in a kind of US sense. We're much more constructively engaged, I would suggest. And we do quite a lot of work behind the scenes on this. We don't particularly like being in the media with regards to our engagement with companies, but we do roll up our sleeves and get stuck into the businesses that we invest in. I run the fund out of Harwood, which is the hybrid family office founded by Christopher Mills many years ago, the legendary British investor. He has a couple of investment trusts himself. There's another one in the building, Edison, and we have a global equities team. But I think really relevant as well to Rockwood is that we also have a private equity team and a private credit team. And their perspectives I do find genuinely helpful when considering new investments. And this is the only thing I do. A range of my competitors do other things as well. But Rockwood is I'm all in on Rockwood and fully aligned with the shareholders. My family and I own just under 1% of the trust. And Christopher Mills owns around about just over 15% of the trust. So we have genuine skin in the game. Now, the long-term small company effect, I suspect almost everyone on this call should know about this. But the point is that over longer holding periods, it's the sort of holding periods that actually align to life or the length of our grandchildren's time that we're saving them for, or indeed the outlook through to retirement or even during retirement. UK small companies do better than large companies, shown very clearly here. And the smaller that you go, the better it gets. So the DNSC 1000 XEIC, it sounds like an ETF, but it's not. You can't ETF this part of the market. It's too illiquid and difficult. Is the Deutsche Numis Small Companies 1000. It's the bottom 2% of the market, tracked back to 1955. And you can see that there is a very material outperformance the smaller you get, the next being the bottom 10% the index of the market, then mid caps, and then large cap. Obviously, in the UK, there's been a large domestic exodus of investors over the last few years, and it's fair to say that the last few years of higher interest rates have affected the ability of growth asset class like UK small caps to attract new capital. But I do think there is scope for optimism. Pension fund allocations literally can't get any worse. I think the average UK DB scheme or other scheme is actually underweight the MSCI global weightings for UK, which is about 4% of portfolios. And this is quite interesting, given that UK has actually beaten America for now 2 years in a row in terms of performance versus the S&P 500. And if it wasn't for Iran, we'll get on to Iran in a moment, actually the inflationary impulse has been dampened since the invasion of Ukraine, and interest rates have been falling from their peaks, which is a positive effect for risk assets and also generally for investment into the economy. There have been multiple initiatives to try and improve this. We'll see whether they amount to anything. There still hasn't been a British ISA. It's a personal crusade that I'd like to one day see a British ISA be reinstated. It was the case before with Papst, but maybe that won't happen. But in any event, Xing out Iran, inflation has been okay and interest rates have been falling. That does seem a little as if not in the real world and a bit like hope over reality. And so clearly the invasion of Iran has not been very helpful of late. We won't go down that rabbit hole with regards to the whys, the wherefores, the strategy, the approach, and also the other more controversial aspects to Trump's approach to diplomacy, relationships with so-called allies, international multilateral organizations, or indeed negotiations with the enemy. But it's fair to say that it is going to have an impact this year on earnings, on EBITDA, on earnings before Iran, as well as what's going on with tariffs, now proven illegal, but still bits and bobs going on. Donald's further pronouncements, and more recently, the concerns about the impact of AI on various industries. The key thing I would say here is that, what's in the price, and the top right chart here, I do apologize if you have to get out your spectacles, but this shows previous drawdowns of small cap versus large cap performance since 1990. And you should be aware that FTSE 100 obviously being large cap UK shares have actually been performing well for quite a while now, quite a number of quarters, but small caps not really participating. And the red line shows this cycle, which is clearly different than every other cycle since 1990, where underperformance of smalls versus large has righted itself through a period of strong outperformance of smalls versus large. And, I would say it's kind of overdue. So that should be coming soon. And obviously valuations, which have been more widely touted by my competitors and the general market commentators are clear, is that UK small companies are definitely cheap, which is definitely a precursor for any period of stronger performance that can be sustained. In fact, that FTSE 250 chart, which is pretty much a good proxy for small, they've actually got better data. I think that's a very good reflection of probably what small versus large is in general. Shows you that we're down now in valuation relative terms to large cap, back to as early as 2001, which is actually when I was first given my first UK smaller companies fund, now over 25 years ago. And it's fair to say at that point, large had been doing a bit better than small for a period. And it did open up in the early stages of my career a period of revaluation of small and mids as they realised the growth effects and the ability to create value was easier in smalls and mids, underpinning that long-term small companies effect. So we're all pretty pessimistic. That's probably a good sign for future returns. What have we been doing just in that backdrop? Well, I am delighted to say that the medium-term performance is still best in class. We're number one UK domiciled fund over the last 3 years and 5 years and 6 years. However, the last year, the year to the end of March 2026, was pretty disappointing as a result of the Iran invasion. In fact, I think around about, and not think, I obviously checked this, around about the end of February, just before Iran, we got our NAV up to about 303p per share, which would have been was showing a sort of 21% rise on the year, and Iran has taken that away as the markets sort of indiscriminately repriced equities, market makers knocking their numbers down, not in the face of no underlying fundamental changes to those businesses, just a change in risk appetite and potentially the outlook for interest rates if this conflict lasts for longer. Obviously, since the point where I cut this chart to this table to the end of Q1 2026, we've actually already been rallying relatively significantly, and we're back up to, I think we closed the quarter at 266. We're up to about 285. We're trading just below the NAV, almost at the NAV. That closed in. We were temporarily at a discount. However, for the last 3 years, we've basically traded at a premium of a modest premium of about 1-3%, pretty much day in, day out. And we would expect that to be incoming very shortly. So, buy whilst a discount lasts would be my recommendation. As I said, things are improving. I think our medium to long-term record speaks for itself. We're very proud of that. For those that don't know how we've achieved it, well, we're picking in this significant UK universe of small cap stocks. We're picking proven businesses with identifiable assets or proven business models that have often fallen on difficult times, either through their own issues or incompetence or errors, or maybe through poor M&A. And so we have a kind of value and recovery mindset, which is quite differentiated from most of the more growthy mindseted small company managers. We're looking for mean reversion. So what that means is, we're looking for companies that used to produce a lot of profitability and now don't, where we think that can mean revert, and also where the valuation used to be fair or appropriate or at this level for many years, and then has been kind of impacted by whatever's been happening in the business and pessimism set in, and we think that valuation can get back to a fairer, more an intrinsic value of the business. Usually requires change. And that's where we engage with the other stakeholders, shareholders, board, management, advisors, to try and catalyze that change or accelerate that change if it's already happening, and just keep everyone's sort of feet to the fire with regards to that. We also develop an exit thesis at the point of entry, in order to mitigate some of the sort of illiquid aspects of this approach, which is perfectly suited to the permanent capital and an investment trust. And as a result, we really want to make sure we've got ways we can exit our holdings once they've delivered that value. The whole process, as I've said, matches our time horizon. It normally takes 3 to 5 years to come through. There's always exceptions to this, sometimes faster, sometimes a bit slower, but this is pretty much what most of the companies go through. And you have this stabilization phase where whatever's been going wrong, it's starting to be addressed. That's when we typically start buying. It's actually the most dangerous in terms of phase, particularly for private investors. So I wouldn't encourage you to, unless you've got sort of a strong constitution, to sort of copy what we're doing just after we've bought stuff, because almost inevitably there's further bad news to sort of emerge out. We're comfortable with that because we've done enough due diligence to understand that the ability to grow and create and the discount to intrinsic value will outweigh that bad news that the market may still react negatively to in future years. But that's the period where we're changing management, maybe doing a refinancing or putting money in. And after that period, and they've sort of sorted, they've sort of fessed up. Usually, the new management have sort of opened up about all the problems of the business, you start moving into this delivery phase where the returns can be improved under a kind of unbaggaged new management or board or strategic approach. And that delivery phase can last, 2 to 3 years. And during that phase, the confidence is being rebuilt, returns are being rebuilt, valuation should start improving to a certain extent. But finally, you get through to a realization phase where everyone goes, well, actually, that's company's now off the naughty step, and aren't they doing well? And it's prepared. So the market's either prepared to put a proper valuation on the company's earnings, or outside third parties notice that the stock market is not doing that, and then launch takeover offers or bid offers for the company. That's either from private equity or from trade and strategic buyers. So onto the portfolio. What have we got? So these are the top 10. You can see, for those that don't know Rockwood, there's a good mix of businesses in here. I did mention that 250 million market cap point. I mean, and a number of these are above 250, but we bought them below 250 million and they perform well, and that's why the market caps are now higher. We don't need to sell; that would be insane. So we run our winners, but a good mix of end industries. Very well diversified across this top 10. You can see the kind of weightings we've got. Ideally, we'd actually have a bit more in the top 10 in terms of weighting than we have now. But one of the things of being on a premium is that Rockwood, has been one of the fastest growing investment trusts over the last couple of years. A year ago we were 100 million, we're now 150. A year before that we were 60. So we've raised quite a lot of money, and it's in some of our situations, even though they've been delivering, it's been inappropriate for our ongoing return targets just to keep adding to the position after it had gone up quite a bit. So the weightings for some of them have been slightly diluted by the growth in the growth in the strategy. I'm going to talk about a number of these stocks in a moment in more detail, but ones which I wasn't planning to, I should just cover off very quickly. In the RM, our largest position, which is a company which has a fantastic platform business that facilitates the assessments, the exams for students around the globe. I think they actually conducted, over 20 million exams last year, A-levels, international baccalaureate. That business has been slow to, but is going to eventually dispose of two of its divisions, which we expect to happen during this year, probably sooner rather than later. And that should pay off the high leverage that RM has. They've got support from their banks, but it's definitely affecting the rating of RM. And we expect those disposals to move the company into a net cash position. And that should unlock a re-rating of the remaining activities, which are very high quality, very high cash generative. The next few I'm going to talk about in a moment, but I'll just touch on Capital, which is picks and shovels investment. They have it's an international business that provides mining services, as it says, to majors, mids, and minor mining companies with a kind of a bias to gold and copper, but a range of other commodities as well. And that business has grown materially over the years, added in laboratory services as well, which are very much higher return on capital than their drilling services, which is their bread and butter. And that business is obviously going through a much better industry conditions now that the mining cycle has started in earnest. We haven't got any direct mining plays in the fund, and this, I think, is a very low risk way of playing it, not least because it's on an EV/EBITDA of 3.5 times, which is absolutely ridiculous given that they're exposed to some of the biggest mining projects currently underway or coming underway in the world. M&C Saatchi, you may have read, if you're a Times or Telegraph readers, they wrote an article about what we're up to or might be up to there. You'll all be aware of the M&C Saatchi business, although advertising activities themselves, creative advertising, is less than 20% of profitability now, and the rest of the business is much more diversified, and its most valuable division called World Issues, where they provide strategic strategic communications advice to governments, US government, UK, NATO, Australia, is we believe that division is worth more than the entire market cap of M&C Saatchi, which also has net cash, by the way, at the moment, and a number of other divisions, one of which was bid for £50 million late in the second half of last year, which the board quite rightly rejected as being a bit too low. James Fisher and Sons is a defence, marine and energy business, pretty much the cocktail of choice at the moment, I would suggest. And that's a good position to be in for them. It's been sorted out by the new management team there, and they've moved into an upgrade cycle, as I predicted to investors 9 months ago now, and we're getting upgrades from James Fisher. I think there'll be more during this year. The shares are responding really well to that. Finally, Restore. For those that love an AIM stock with what remaining IHT relief Rachel Reeves wants to give us all, it's an absolute cracker. They do document storage and shredding and digitalization of documents as well. That business is now on a P of less than 10 times, generating oodles of cash. Its operating margins are above 20%. It's basically a duopoly for its core business in the UK, which means there's decent pricing tension and scope to grow. And there are other areas where they've got further consolidation opportunities. It's run by the guy who really built the business up, Charles Skinner. We think that's an absolute no-brainer, and the sort of classic share that if small caps generally start to do better could easily re-rate back to its long-term PE of being about 16 to 18 times. So that's without doing anything. That stock should re-rate up 60 to 80%, let alone what they're doing growing profits. This slide has the whole portfolio on, and I don't believe in thematic investing. I think it's a dangerous way of thinking about investment, and often used by professional fund managers to market rather than their funds, rather than actually the fundamentals of appropriate style investing. I don't think Warren Buffett ever talks about themes, to be honest. So I've just put this in these categories, just about how my mind's sort of approaching the portfolio at the moment. On the far left, you've got catalysts pending. I mentioned RM already. The one I wanted to mention now is Capita. And why this is so interesting is that this has just had its catalyst announced in the last couple of weeks. But because of all the Iran distractions, the market did reward it a bit with a bit of performance on the day. But really, this is an absolute transformational deal for Capita, who have sold off their remaining loss-making business, the contact centers business within Capita, to the private sector, which they'd struggled to get back to profitability. And they've essentially given it away for a quid with some deferred consideration to a private equity firm, and offloaded a few of the leases as well. It unlocks a load of cost savings for them and means that Capita is now focused only on two divisions: one, the public services division, and the pensions business. Now, just to take the first, what's he talking? The Capita is now, I think, 330 million odd market cap. We think that the public service division is worth over £1 billion. Now, you'll find people in the AI world making these sorts of assumptions, but really they've got nothing and no financial information. Really, it's just all on a spreadsheet to sort of justify that kind of a statement. But the reality is, Capita in the last 12 months has grown its public service division by 4.4%, so much higher than GDP. Its sales were over, I think, £1.5 billion. Maybe £1.4 billion. And they made £135 million of operating profit, an operating margin of over 8%. They converted 88% of profits into free cash flow. And we think that business is worth over £1 billion. I think that is the case intrinsically based on its future cash flow profile. The other business, small pensions business, which is even more profitable but much smaller, it's going to be about 20% of profits, and that's also doing very well. They have one problem contract which they took on when it was a problem for the government in December last year, the civil service pension scheme, which if you Google, there's quite a lot of noise about, but it really, they've taken that on to help the government. They've taken on other people's mess, which they're now working very hard to sort out. I have no doubt at all that Capital will have got that situation for the civil service retirees into good shape for them, by the summer. And I know it's very difficult for those that are affected by it, but that they've been brought in to sort it out rather than create that problem. The second thing here I would turn is the realization phase. So since year end, slightly irritating for me for my quarterly performance numbers, but Van El was bid for last week or even Monday. I don't know. I lose track, but basically Van El's just been bid for, which is really positive for us at a 62% premium to the undisturbed share price, which is great. We get back, we'll clock an IRR of just over 13% for Van El, slightly below that 15%. We'd hoped that they would have been taken over a year ago, but it's been a difficult backdrop, but they've done it in the end, and that cash should drop into the portfolio shortly. I've mentioned M&C Saatchi, where we have been involved with other stakeholders in shaking up the board. The CEO's now left the business, and we've got two new board directors, the excellent Nick Schott, who ran investment banking at Lazard's, and Vin Murray, the extremely highly regarded tech business lady. And she's gone on to that. And I think there is a huge amount of value that they will realise for shareholders now. And Centaur Media has been in the portfolio for some time, but we've just received all the proceeds back from that breakup as Martin Rowland we put in as chair of Centaur. Shares were 22p, and he's just returned the vast, huge amounts of cash of 48p to shareholders. You may have seen in one of those columns was big 2026 expected. These three companies, Funding Circle, Vanquis, and Filtronic, make up nearly 20% of the NAV. And if I ask you to start with Funding Circle on the left and just cast your eye down the chart rows, you'll see that they moved into profitability in 2024. That was helped by an engagement that we had with them about taking costs out of the business, which they did. They also exited their activities in the United States and achieved profitability earlier than expected. They then had with their growth, which is great at Funding Circle, lending, facilitating the lending of money to British SMEs. The profits grew to 20 million. We're expecting them to pretty much double again in 2026. We think the stock market can't keep up with the progress at this business, and we think they'll grow again at 50% in 2027. That P for that, you get a P of less than 10 times, despite huge amounts of cash. A quarter of the market cap's on unencumbered cash on the balance sheet. Very low valuation for a platform business, now highly profitable, delivering, growing. We expect a material re-rate as the market appreciates the level of profit growth coming through in the business. Similarly, Vanquis, which was the old Provident Financial, there we've got a brand new management team. Well, not brand new today. They came in now probably 2.5, maybe 3 years ago, maybe 2.5 years ago. New chair, new CFO, new CEO, and various other changes they then made within the business, introducing better technology, which completes the new systems complete this year, all on track, taking huge amounts of costs out of the business, dealing with a range of problems that they'd inherited. Best exemplified by that £138 million loss in 2024. Can you imagine what the stabilization phase felt like in that investment? But they're through it now, and they delivered profitability in 2025, announced earlier this year. And we expect another very material increase in profitability from that business in 2026. Again, we think the market is behind the curve on this, still catching up with the pace of change. And it's only on a P of 5 times, half book value. Just crazy. Really, really well run business now by the guys there. And just finally, in terms of big 26s, Filtronic, a stock which has got quite a big following in the private investor universe. in the last 12 to 18 months. It's been a massive winner for Rockwood. They have actually announced, since I did this slide, a new unnamed customer in America. And it's our belief that that customer is a very material potential source of new business for them over time if they deliver the products that they want. They basically are, as that little bottom box says, the only people capable of providing a particular type of technology that the low Earth orbiting satellite networks need now, whether they be Starlink, which Filtronics supplies, or future satellite networks which are going to go up. But there's obviously SpaceX are miles ahead of the rest of the game. But the rest of the game are starting to deploy their satellite networks. We think they're going to need Filtronics products, and we think the opportunity there, as these snippets from their presentation show, are very, very significant in relation to Filtronics' current business. Our core holdings are ones where we've sort of, we've rolled up our sleeves so far, it looks like we're wearing vests, basically. You can see the second column, the types of stakes we're taking in these businesses. Just to remind you, we're doing that so we can really influence change and make sure stuff happens, and also because of the conviction of the undervaluation of the opportunity. But in every single one of these companies here, we also have introduced or have a board position on those companies, apart from Van Elle in red, which has been sold. So we've got to where we needed to without having a board position. In all the rest, we do. Excuse me, sorry, that's inaccurate. Videndum, we don't have that in Videndum at this stage. But if you take someone like STV, we've just been involved in an engagement which resulted in a replacing of the chair with Clive Wiley, a man that we know well, who solved and sorted out the much troubled De La Rue and made a fortune for investors recovering value there. He's now just gone into STV. But you can sort of see the stakes there, and also the sort of size of those companies where we take these bigger stakes. Conscious of time, want to make sure you've got lots of opportunity to ask questions. The springboard opportunities, the ones where we're not necessarily, we're either going to take a much bigger stake and roll up our sleeves, or we just feel it's got all the right criteria for making lots of money, and that capital be a good example of that, where we just can't help ourselves. There's good recovery potential, there's good valuation, it's well run, there's changes been happening. We just think the market's ignoring it because it's a small company and people just ignore these sorts of companies. So we have a few of those which are just opportunistic investments, again always needing to double and always needing to having a 3 to 5 year time horizon. And then some are springboards where we're considering, do we go up to a big position or not? But there's an opportunity to make money in any event. I'm not going to dwell on those more. Maybe they'll come up in Q&A. So what I wanted to finish on was it's actually our biggest investment in Rockwood's history so far. The wonderful Tom Cruise you can see there in the sequel Maverick. But in front of him is actually one of the cameras there, and hidden in there, you can actually zoom in on it if you need, but the top of the tripod, there's a thing called a fluid head, which is a really important piece of kit that the camera then sits on so that it can move about freely and effectively. And the world leaders in fluid heads, a brand is called O'Connor. In fact, the O'Connor branded fluid heads were used for every single Oscar nominee in this year's Oscars. And that brand's actually owned by a company called Videndum, which I've actually followed for over 20 years. Quite a few of the companies in the portfolio I've actually followed through results and either been a former shareholder or in and out in various of my other parts of my career. But Videndum used to be called Vitec. It's been listed for a very long time. But as these bullets show you, I wouldn't expect you to read all of this right now, and this is all on our website if you want to look it up afterwards. They own the O'Connor brand. Their primary brand is actually called Manfrotto, which is the world leader in photographic and camera tripods. and a number of other brands, including I didn't even appreciate the eponymous AutoQ, a bit like Hoover. They actually own AutoQ. Their end markets, nearly half of it are now what we call independent content creators, the YouTubers, the TikTokers, all the rest of it, vloggers who need a lot of this kit. And I think we're safe to say that's probably a structurally growth market or here to stay. And then 28% goes to the film and TV industry, and the rest are broadcast, outdoor sport. They've just done a big package at the Winter Olympics. So you've got the actual Olympics coming up. They'll be doing lots there. And they've got a really strong moat. So they're 5 times the bigger of the number 2 globally. The main competitions are actually Chinese, where the quality is clearly inferior. And actually, as a result of changes the company's been making, they're now cost competitive with the Chinese anyway. Big sales into the US, as you might imagine. Now, this business, classic sort of Rockwood situation, the prior management team really did get it into a bit of a mess. So the former CEO, they did 250 million pounds of acquisitions. Note the market cap at the top of the screen. They did 250 million acquisitions, mainly with debt. And they ended up with 42 unintegrated business units. So essentially, they ended up losing control of the business and the balance sheet when external events didn't go their way. Primarily the COVID, where there was obviously a lot less activity going on, but also the writers' strike and sort of all of those issues. As a result, they've had to need a full refinance of the business, and that completed in the last week. And we took part in that in a material way, which is why it's now 6% of Rockwood. The exec chair is a guy called Stephen Harris, who's got a fantastic reputation, turned around Bodycote, made everyone a lot of money in Bodycote shares. We think he's excellent. He fired the CEO and CFO when he came in as non-exec chair, made himself exec chair. He's now recruiting a full-time CEO now that they've passed through the refinance. It's all a bit shaky for everybody prior to that to get the right type of candidate. And now it's refinanced, they will have the opportunity to address all the other opportunities to improve profitability of the business. Now, again, with this kind of recovery situations, a lot of fund managers just sort of deem it sort of too risky, too difficult, or whatever. But I talked about mean reversion near the start of this presentation, and I just urge you just to look at the table on the right, which takes the adjusted operating profit from the annual reports going back over the last few years, and you can see that this business did for many years generate quite a lot of profitability, despite not being integrated and having all the opportunities you have from having a fully integrated manufacturing group. And you can see the kind of operating margins. Well, Stephen says that his target is to get the business back to 350 million of sales and make a 15% operating margin. We actually think they can do better than that eventually, but let's just be conservative and just go for that in the first instance. And on that basis, we're targeting EBITDA of over 60 million quid, profits after tax 35 or so. And if you put that on a very paltry one-time sales, you get to 350 million of value, and the shares should more than double from here. Now, if you've still got your spectacles on from earlier, you'll see, I'm really apologize, it's not meant to be one of those eye test things, but the row right at the bottom, which has the addendum, those are the EV to sales, so the value of the market cap plus or minus its debt or cash versus the sales of the business. You can see that ratio, going back over many years, has basically been always above 1. And we're just targeting getting back to 1 to get to 350 million. But actually, our intrinsic view is that a higher multiple than that should be sustainable. And as a result, we are really excited about what this might do for Rockwood's NAV over the next few years. So to recap before Q&A, I've done it great. We've got 20 minutes. If I can do this in 30 seconds. We've got a value bias, although obviously some of our companies go on to grow very fast, but it is a value, which is what attracts us, not the growth rate. It's a proper small cap bias. We're not buying the £1 billion market caps that lots of small cap managers buy, and markets are clearly depressed. I've been doing this a long time and I love it, and we think it's a great time to be deploying this strategy in quite interesting end markets. And we're targeting these 15% returns per year, annualized over 5-year holding periods at a gross level. We're active, we're focused, and we're fully aligned with the shareholders and any of you that choose to join the register. So with that, I'd like to say thank you very much, and we can go hopefully to questions.
Thank you, Richard. A great presentation as always. We'll now begin the questions and answer session. Anyone who wishes to ask a question can use the chat function. And we already have a couple of questions. The first one being on the strategy's capacity. Is there a limit to which you believe the trust should grow before the returns are compromised by its size, which would restrict its ability to buy worthwhile holdings? If the trust reaches such a size, will it redeem shares?
Yes, so the answer is yes and yes. So the actual number itself has got a bit more art to it than science. It's relevant to what we see as the opportunity set. The opportunity set being the bottom part of the small cap market, where most small cap managers rarely play. And in that regard, it's right now. That opportunity is below probably about 350, 400 million market cap and below. They do have the occasional thing, but below that. We think the capacity of the strategy is probably between 250 and 350, that sort of thing. And when we get there, we will, or think we're worried we're getting there very closely, we will definitively start to execute measures to manage the size of the portfolio. Whoever asked that question, I'm sure is in the back of his mind what I think is one of the worst things that the fund management industry has continued to do, which is allow their fund managers, when they're doing well, to raise far too much money. And I'm not going to name names, but it's a consistent commercial over a client battle in my mind, which often the client ends up not winning it. The key here is that at Rockwood, not only have I expressed I've got a significant amount of money myself invested in, as has Christopher, but also we have a performance fee alongside our management fee, which is absolute only, and only if absolute returns over the hurdle are generated. And I definitely would not want to compromise my ability to continue to generate a performance fee. It would make no sense for me whatsoever.
Perfect, thank you. The next question is regarding your exit options. When you take a large position in a company, are you not wholly relying on a takeover to exit the position?
A good question. So there's two aspects to this. So the first is that quite a lot of the time we are, but we're not per se concerned about that. So far since I've been running the strategy, we have had a material number of M&A exits. As a percentage, probably higher than all other small company fund managers, because they'll own 80 stocks and they'll have a few bids a year, or 60 stocks, but they'll have a couple of bids. Since with our much smaller number of holdings, we've had a range of bids over the years, whether it be Crestchick, Augean, Finsbury Foods, onthemarket.com. We've just had Vanel. And actually, I'm not inside on these things, but we would expect to see 2 or 3 more bids in the portfolio this current year. The smaller you have, the smaller the market caps you are, the more you are reliant on a big weighting with some sort of financial exit. Because if I say buy a £30 million market cap company, or even a £50 million market cap company, and then it does what I expect and doubles in size to 60 or 100 million, there's still almost no fund managers that will buy my hot stake off me, or want to take that stake, and it takes ages, and you can't really realize. But because the fund now, Rockwood's grown, it's one of the reasons we're comfortable still growing it further from the current 150 million to 250 or so. Is that we're now finding situations like for instance, Vanquis Banking or Capita, if they start to really deliver for the portfolio, we will definitively be able to sell those in the market. You've also, the person that asked this question has walked into my trap. Not really a trap, but I've just thought I didn't mention Galliford Try, which was on this slide, which was one of our springboard opportunities, and that's an exact opportunity where we took a decent sized stake in Galliford Try, and actually during 2025 we sold that to other fund managers. We made 2.4 times our money. It had gone above the sort of 300 million, 350 million, 300 million market cap, and actually. At that point, the market often will take our companies. They've often at that point, remember, they've got really quite strong momentum if things have gone well for us, and that's attractive to a number of other fund managers to have different types of styles of investing. I think the flip side to be completely, as always, completely transparent. It's when things don't go so well and we've got the big stake. Then we really have to push for liquidity or an outcome in order to get our money back. And we've done that 2 or 3 times where we've got things wrong, and then we've ended up fighting our way through to a transaction. We've pressurized the board to realize that for investors, and then we've ended up getting our money back, or roughly getting our money back.
Excellent. And actually, Richard, you answered. Another question came in on the exits when the investment thesis isn't working, so I will skip that. And then,
Milosz, let me just flesh it just slightly for whoever asked that specific question. I think so. The way it is that sort of there comes a point where we go, this isn't working, either because the stock market hasn't recognised all the progress the company made, or we've got it wrong and the company haven't realised that they've got it. There is a problem here with overall the likelihood that we can make a material amount of money. And then what we do is, at that point, we know most shareholders will probably agree with us, and we'll go and speak to them and we'll say, look, we think that it's game over here. The best thing to do is to try and get an outcome somehow. And what do you think? And they'll go, yeah, we think that makes sense. Or if they all say no, Richard, give it another few years. We go, okay, fine, okay, right, okay. Maybe we're being too impatient or something like that. And then we'll engage with the company, knowing that most shareholders are basically supportive, and say, look, let's see what we can get. Let's see what interest there is from trade, strategic, or private equity for the business. And that typically will end up being a premium to where they're trading on the stock market. And that process does take a bit of time in itself, often up to as long as a year, because you've got to prep the company, do all the data rooms, and so you've got to appoint advisors and all the rest of it, and then there's due diligence and all the rest. And that's how it goes. But what I can say now is that actually, the only let's call them out. The main one, for instance, which hasn't worked out, which is where we've got a loss on, where is facilities by ADF. It's a very small position for the portfolio. It's actually less than 1% of the portfolio, but they've got to turn around that business soon. Otherwise, it's probably better off as part of a bigger business. It's not in realization, because we still think we rolled up our sleeves, we changed the chair, and then got basically changed the CEO and the CFO, and we changed the stockbrokers, and now they're going to try and create a recovery. But if the market still just doesn't care, then I think everyone will say, well, let's just see what potential strategic or trade buyers would want to own their significant fleet of essentially, it sounds weird, but trailers for the film and TV industry, where they're the sort of joint market leader alongside 2 other players in the UK.
Excellent, thank you. That's very clear. And the next question is more on the impact of the macroeconomic environment. Are you worried by the UK's lackluster economic growth, and what is the environment like for small UK companies?
Yeah, so I think with regards to the economic environment, I mean, it's been pretty awful, hasn't it, for some time? I mean, I don't think we used to sort of complain a bit in the UK when we used to sort of do two and a half a year. Now we'd be delighted for two and a half a year. I think the current forecast is for 0.8. Clearly, the balance between, I'm not going to go political here, by the way, but the balance between state and private sector is at a very dangerous tipping point where one is sort of overwhelming the other. And the environment for businesses is clearly not that conducive, whether that be from corporation tax through to red tape and all the rest of it. I think if you look at our portfolio, though, we have actually very limited exposure to UK GDP. That's really, really important piece. So if you take whatever Tribal, it sells software systems to 140 institutions around the world, but half the Russell Group universities who are all upgrading their on-premise IT systems to the cloud. And Tribal's basically at the forefront of that. Nothing to do with GDP. Now, that doesn't mean there aren't other problems that they're faced with, but GDP, the level of economic growth, we don't have consumer exposure. The only house building exposure we've basically had is via Van El, which is now gone. Restore's document management is as very stable as anything type activity. Funding Circle is lending to SMEs who always need to borrow money. They just got to make sure they don't in a more difficult environment, they're still making sensible lends. Filtronic is exposed to Starlink and whatever other satellite networks are going up. So you sort of look at our portfolio, we've got limited cyclical risk and we've got quite a lot of pots of growth which are overseas. I mean, just to very quickly, Eagle Eye Solutions, a relatively new holding, it's selling its leading edge AI enabled loyalty software into America. We believe they've just sold Walmart, Mexico. They've sold it to Woolworths in Australia, Canada, France. A Treat, I think nearly half its sales are ingredients into US and Asia. Cood's largest customer is the state of California. Capital's major projects are in Nevada, big copper project there, and big copper gold project in, we won't be going on the site visit, by the way, in Pakistan. So quite a lot going on. So that would be the main thing on macro. The overall point on UK small cap is that if I didn't labour the point enough at the beginning of the presentation, I'm afraid I'm going to have to labour it here. But just go back to this. Let's just hang on. I've got to find the apps. Let's go back to this. The last 5 years, that's the fifth column along, the AIM market has fallen 40% throughout entire period. And the FTSE small cap has only made a 5% return over the last 5 years during a period of rubbish UK GDP. And this differentiated, different approach to UK small cap investing has delivered 100% upside. So I'm basically, it doesn't mean we're complacent, but we are navigating it in a way that what's happening with small cap is not a big deal for us over any sensible time horizon.
Perfect, thank you. And maybe you can also shed some light on what we expect in terms of the impact of the current macro environment and the geopolitical situation maybe on the activity across M&A markets. I think you've mentioned that you expect 2 to 3 bids this year, but maybe you can shed some light on the near-term outlook in terms of this activity.
Yeah, sure. Okay. Look, I think that it's twofold. So there's no doubt that the war's main real-world effect, other than possibly undermining the dollar, medium to longer term, or strengthening the concerns that the dollar is being undermined medium to long term, is inflation seeping into the system in a systematic way, which raises inflation expectations around the globe. And you'll have already seen emergent articles, not just about what's happened to oil and gas prices, what's now starting to happen with fertilizer prices, which will then feed into food prices and the rest. and the rest. And obviously, as I hope all the listeners know, the inflation rate is what's driving the interest rate, and the interest rate drives the cost of debt for those undertaking leverage transactions, which means private equity primarily. They don't always use lots of leverage, but they tend to. And equally, corporates themselves who will try to be financing acquisitions with a mix of debt and equity. It equally means that you can put your money, let's face it, into a kind of government bond. And if you think the UK government, US government aren't going to go bust, you can get near as damn it, 5% a year locked in for 10 years, which doesn't make you particularly rich, but probably does grow your real capital, probably over that period, which doesn't make a lot of people, particularly the slightly odd asset allocators who sort of just don't want to lose their jobs, into anything slightly interesting, like very undervalued UK small caps that have already been very weak and are very cheap. But let's not lose faith in capitalism overall. There are lots of entrepreneurial people. There are lots of ambitious management teams and well-financed businesses, PE funds with lots of dry powder that don't necessarily have to use leverage, that will be looking at UK listed companies, particularly the smaller ones, and going, yes, thank you very much, we'll have that at half price all day long. And by the time the cost of debt's down to lower levels, we'll have found some other things to bolt onto it, and we'll grow value that way around. And the most rose-tinted and glass-half fulls of those may even think they might even be able to IPO what they buy at the end of that process. But I wouldn't encourage them to hold their breath.
Excellent, thank you. I think we have time for one last question. So maybe we can come back to your portfolio. I think you've just briefly mentioned Couth, which you present as one of the companies with spending catalysts. So maybe you can shed some light on that one.
Yeah, sure. Couth is without any. I'm trying to. It's not letting me. Here we go. Couth, which is fifth down on the in that table. You could see market cap of £39 million. Actually gone up slightly since the end. It's actually having quite a good day today. Last couple of days, it's starting to rally. I think because the management are actually doing the rounds and the people are kind of, the penny's starting to drop. I mean, look at the valuation there of EV/EBITDA, 1.5 times. I mean, that is just ludicrous. So this, for those that don't know it, Couth is the world leader in digital mental health provision. They customers in the UK, over 100 NHS trusts. It's focused on a digital service which they market on behalf of the trust into schools and higher education facilities around the UK. And what it is a anonymous way that young people can access professional counsellors, but via an app, essentially, which is how the youth want to interact. So when little Johnny or little Jenny don't really feel comfortable speaking to siblings, parents, the football coach or mates about whatever it is they're worrying about, they can go onto Couth for free without putting in all their details and basically access a real person and chat with them about what they're thinking, and then that can progress to proper counselling and help as needed. The idea being it's very cheap to when you manage it like this to give this service relative to physical-based NHS-based provision. It's earlier, so it avoids the problem becoming worse and more expensive sadly down the line. They've also won the state of California, and it shows that they are best in class, where they've enhanced and improved the system for the Californians. And in fact, they're now coming back and upgrading the UK system this year. The market's gone in a complete funk about them retaining their contract in America. And essentially, because that's about 2/3 of sales, that one contract, they're very worried if they lose that, there's sort of problems. Now, I would just say two quick things. Firstly, we think that the cash the business has, which you can see is £22 million, plus the value of the UK business, which is profitable, it's been stable for the last 2-3 years, or stable to slightly declining because of NHS budget issues, but it's now actually starting to grow again, is worth at least the whole market cap. So they could lose California and it all be in the price. We actually believe that California is going to be renewed. We think they've released LA County, various universities and other public sector bodies in the US have released lots of very positive praise about what coup they're up to. And we think that they're in a very strong position to continue providing for California. They also recently won a new state. They once won Michigan, and they've also won New Jersey. And frankly, they could be in quite a few more states. And they also could be in quite a few more countries. And it's the gross margin at coup is 73%. So if they do start to win in other places, and in somewhere like Michigan, they're initially being targeting over a population in one school district, about 100,000 students. But the potential is 1 million students, so land and expand. This business has got potentially very, very bright future. So I think it's a classic UK small where at 40 million with 20 million in cash, this thing ain't going bust. It's also profitable. I mean, it's highly profitable. The EV/EBITDA implies that if you work out, I think they're going to do 11 million of EBITDA this year. And if they retain California, it's kind of a recurring revenue style business, which is what it's been in the NHS, where they keep returning. They're part of the service in those NHS trusts. So we think coup can triple, quadruple from here over the next couple of years, and it could be very rapid when that starts to happen.
Excellent, thank you. We are now approaching the end of our session. So Richard, thanks again for all the insights, and thank you to all our participants who joined our session. Have a good rest of the day.
Thank you so much, everybody. Really appreciate all the interest you have. Do get down to our website. There's loads of stuff on there if you're interested, and sign up for the mailing list. We now have a mailing list function where I sort of send, not all the time, but just maybe a couple of times a quarter, what we've been up to and some interesting snippets. We won't clog up your email boxes any more than that. And thank you very much.